From the year 2000 to 2007, trade with China destroyed nearly 1 million US manufacturing jobs. That's apart from other job losses due to technology and productivity gains and automation. Since embarking on economic reforms in the late 1970s, China has transformed itself from a poor agrarian society to the world's second-largest economy. This metamorphosis has been driven by a combination of state-led initiatives, foreign investments, and a relentless focus on manufacturing and exports. This transformation has had a seismic impact on the global economy, particularly on the job markets of Europe and the US. Many industries in the West have felt the pressure of competing with China's lower labor costs and efficient production capabilities. Recently, leaders from the United States, France, Germany, and other G7 countries have raised concerns about overcapacity in China's economy, particularly in the areas of electric vehicles, solar panels, and batteries. Chinese President Xi Jinping, however, denies that overcapacity is an issue. This situation has significant implications for both China and the West. The European auto industry is feeling the heat from China's EV market. Chinese EV brands are becoming increasingly popular among European consumers due to their attractive features and lower prices. Meanwhile, the European auto industry is facing factory closures and significant job cuts. For example, in February last year, Ford Motor announced it would cut 3,800 jobs in Europe. In June, Swedish car parts manufacturer Autoliv said it would eliminate 8,000 jobs, mainly in Europe. In October, Germany's Volkswagen had announced it would cut 2,000 jobs in its software unit, Cariad. In November, French tyre maker Michelin declared it would cease operations at 3 sites in Germany by the end of next year, affecting over 1,500 jobs. This January, automotive supplier Bosch revealed plans to cut 1,200 jobs in its software development division by the end of 2026. In March, car maker Stellantis confirmed deals for at least 2,500 voluntary layoffs in Italy, following its announcement last June to close a 40-year-old plant in Austria, impacting 300 jobs. These developments underscore the growing influence of Chinese EVs in Europe and the subsequent challenges facing the European auto industry. In fact, something like this has already happened in the past. Economists call it the China shock. It refers to the sizable increase in Chinese imports into the United States in the 2000s, which eliminated more than 2 million American jobs at the time. Experts warn that the second China shock could be even larger than the first. So, is history going to repeat itself, and how is the West responding to China's overcapacity issue? More importantly, how did China get to this position? Join us to find out in this video. Why a second China shock is imminent. For much of the 20th century, China remained largely isolated from the global economy. However, under Deng Xiaoping's leadership in the late 1970s, China embarked on a path of economic reform and opening up. These reforms dismantled the centrally planned economy and embraced market forces. The results were nothing short of remarkable. China's economy experienced explosive growth, averaging nearly 10% annual GDP growth for several decades. This unprecedented expansion lifted hundreds of millions of people out of poverty and transformed China into a global economic powerhouse. Fast forward to 2024, China currently possesses 4 key advantages. Number 1, China holds a 30% share of global manufacturing. Number 2, the country benefits from comparatively cheap labor, especially in comparison to Western countries. Number 3, China has developed significant technological capabilities. Number 4, there is massive, consistent, and sustained state support for these sectors. This unique combination of factors is unprecedented in history. We are now facing a second China trade shock in advanced manufacturing, which will exert considerable pressure on Europe, Japan, South Korea, and once again, the United States. As China's economy boomed, it became increasingly integrated into global supply chains. The Chinese government offered tax breaks, subsidies, and even built entire industrial zones to attract foreign businesses. Western companies, enticed by lower production costs, began outsourcing manufacturing operations to China. As per a recent survey, there are a total of 8,619 US companies which are established and running in China. The allure of reduced expenses was too significant to ignore, especially for industries facing intense competition and shrinking profit margins. This shift was driven by China's abundance of cheap labor, its careless environmental regulations, and its willingness to provide generous incentives to foreign investors. This exodus of manufacturing jobs led to a significant economic downturn in many industrial towns and cities, shutting down several factories. The United States, once a manufacturing powerhouse, saw its industrial base shrink, particularly in labor-intensive industries like textiles, electronics, and furniture. According to reports, Tesla, which opened a factory in Shanghai in 2018, now makes half of its electric cars in China. And until 2019, Apple also had about half of its assembly lines located in China. It fell to 36% as of 2021. While outsourcing initially benefited Western consumers by providing access to cheaper goods, it also contributed to job losses and wage stagnation in developed economies. The influx of affordable products from China made it difficult for local manufacturers to compete. Moreover, the dependence on China for essential goods raised concerns about supply chain vulnerabilities, particularly in times of geopolitical tensions. The concentration of manufacturing in one country posed risks that became increasingly apparent, especially during the COVID-19 pandemic, as lockdowns in China disrupted production and led to shortages of critical medical supplies and other goods. This disruption highlighted the need for more resilient and diversified supply chains to mitigate future risks. The real cost of cheap goods. China's economic rise coincided with a surge in global trade. Over the past few decades, China has transformed itself into the world's factory, producing a vast array of goods for export to countries around the globe. However, this trade expansion has not been without its challenges. The rapid growth in trade has led to significant economic shifts and has created both opportunities and tensions in the global market. One of the most contentious issues has been the massive trade imbalance between China and many Western countries, particularly the United States. China has consistently run large trade surpluses, exporting far more goods than it imports. This surplus has been a key driver of China's economic growth, but it has also led to significant trade deficits in other countries. This imbalance has been a source of friction, with critics accusing China of unfair trade practices, such as currency manipulation and dumping goods below market value to gain a competitive advantage. These practices have been hotly debated among economists and policymakers. The US trade deficit with China reached a record $419 billion in 2018. This staggering figure highlights the scale of the trade imbalance and its potential impact on the US economy. This imbalance has contributed to job losses in the US manufacturing sector and has fueled calls for protectionist measures. Many American workers have felt the brunt of these economic shifts, leading to increased political pressure for change. In 2018, the Trump administration imposed tariffs on billions of dollars worth of Chinese goods, sparking a trade war between the world's two largest economies. These tariffs were intended to level the playing field and address some of the perceived unfair trade practices. The trade war has had a mixed impact. While some argue that it has forced China to address some of its unfair trade practices, others contend that it has hurt American businesses and consumers by raising prices and disrupting supply chains. As the global economy continues to evolve, the outcomes of these trade policies will shape the future of international trade and economic relations. The future and how the West is responding. While outsourcing to China has undoubtedly contributed to job losses in the West, it is essential to recognize that automation is playing an increasingly significant role in shaping the future of work. Advances in robotics, artificial intelligence, and other technologies are automating tasks once performed by human workers across various sectors. China, with its vast manufacturing base and ambitious industrial policies, is at the forefront of this automation revolution. The Chinese government has invested heavily in robotics and artificial intelligence, aiming to transform China into a global leader in these fields. This rapid automation is having a profound impact on the labor market. leading to job displacement in sectors such as manufacturing, logistics, and ITE services. The implications of automation for Western job markets will bring more uncertainty, to say the least. In response to China's overcapacity, President Biden announced new tariffs last month on Chinese imports. The White House stated that these measures, which include a 100% tariff on electric cars from China, aim to protect American jobs. Europe's Germany, whose car makers sold a third of their vehicles in China last year, is opposed to the tariffs, according to a government source. In contrast, France has been one of the strongest proponents. Together with France, Italy and Spain, representing 40% of the EU population, have indicated their support for the tariffs. But is it enough? Or more efforts need to be taken to stop China from killing jobs in the West? Let us know your thoughts in the comments section. We'd love to hear from you. Until next time, take care.